I call this meeting of the Ncua Board to order. Good morning, everyone.
Good morning.
Good morning.
Before I call the first item on our agenda today, I'd like to welcome a couple of credit union associations who are joining us today. Both groups are in D.C. area today for the annual Hike to Hill campaign. Our first group of visitors are from the Maryland D.C. Credit Union Association. John Bratsakis, can you stand and be recognized? Thank you for joining us today. And also, our second group is from the Cooperative Credit Union Association. Ron McLean, could you please stand so we can recognize you? Welcome, all of you. We're delighted to have you here with us. You honor us all with your presence this morning. The first and only item on our agenda today is Proposed Rule Part 702, Risk-Based Capital. Staff presenting, Larry Fazio, Director, Office of Examination and Insurance, Julie Case, Director, Division of Risk Management, and John Brolin, Senior Staff Attorney, Office of the General Counsel. Good morning, everyone, and welcome.
Good morning, Chairman Hood, Board Member McWaters, and Board Member Harper.
Good morning.
Good morning.
Staff Attorney John Brolin, Director of Risk Management Julie Case, and I are here to present for board approval a proposed rule to change the effective date of Ncua's risk-based capital rule, which is currently scheduled to go into effect on January 1st, 2020, so this coming January. Before discussing the proposed change in effective date, I would like to provide an overview of some of the history behind the risk-based capital rule. On August 7th, 1998, the Credit Union Membership Access Act was signed into law, establishing a system of prompt corrective action, or PCA, for federally insured credit unions. PCA is based on an institution's level of capital, or what the Act calls net worth. Congress mandated credit unions maintain a net worth ratio of 7% of total assets and required the NCUA to adopt a risk-based net worth requirement for complex credit unions, as defined by the NCUA board. The regulation implementing these requirements went into effect in 2000. In 2012, the Government Accountability Office, or GAO, recommended the NCUA evaluate making changes to credit capital standards. The NCUA committed to a review of its PCA regulations, in particular the risk-based net worth component, and established a task force to undertake the review. During the time period the task force was conducting its review, the other federal banking agencies finalized updates to their risk-based capital standards. These updates were in part driven by changes to the Basel capital standards. The task force's review expanded to include those updates and culminated in a proposed risk-based capital rule in 2014, and that led to the final rule for risk-based capital being finalized on October 29th, 2015. In 2018, the NCUA board proposed and finalized a supplemental rule to the 2015 risk-based capital rule. This supplemental rule made two fundamental changes. One, it increased the definition of complex credit union from 100 million in assets to 500 million in assets, and it changed the implementation date from January 1st, 2019 to January 1st of 2020. As a final historical point, the Economic Growth, Regulatory Relief, and Consumer Protection Act of 2018, also known as S-2155, was enacted into law in 2018, just last year. S-2155 requires the other federal banking agencies to develop a community bank leverage ratio option for qualified banks. This law gives qualifying community banks a simpler option to comply with risk-based capital standards if they hold enough tangible equity. In February of this year, the banking agencies proposed a rule to implement this provision, but have not yet issued a final rule. I'll now turn the presentation over to Julie to discuss the proposed change.
Thank you, Larry. The proposed rule would change the effective date of risk-based capital rule to January 1st, 2022. As a reminder, the NCUA's current prompt corrective action regulation would remain in effect in the interim. The proposed change in the effective date will give the board time to holistically evaluate the NCUA's capital standards, in particular considering three specific changes. The first change involves complex credit unions' use of subordinated debt to qualify for risk-based capital purposes. As part of this review, we would also look at improving standards for secondary capital issued by low-income designated credit unions. Assuming the board approves this authority, it would be beneficial to credit unions to have this authority in place before or concurrent with the effective date of risk-based capital. Staff has been diligently working on this complex subject for some time and anticipate having a proposed rule ready for the board to consider in the near future. Additionally, the proposed change to the effective date of the risk-based capital rule will also provide the agency an opportunity to research and evaluate the implications associated with asset securitization. The agency determined asset securitization is an incidental power for federal credit unions in June of 2017. Since then, we have been exploring what regulatory and supervisory framework needs to be put in place to address this risk the activity poses. The agency's regulatory capital standards will need to be modified to properly account for this activity. As previously mentioned, the other federal banking agencies proposed a rule earlier this year which would incorporate the community bank leverage ratio. The proposed change to the effective date for the risk-based capital rule will give the board time to evaluate whether an equivalent provision to the community bank leverage ratio can and should be incorporated for credit unions. Such an equivalent provision may give qualifying credit unions, complex credit unions, a simpler option to satisfy the risk-based capital requirement while providing good protection for the share insurance fund. This proposed change to the effective date does not represent undue risk to the share insurance fund. The credit union system's net worth is strong at over 11%, and the share insurance fund is healthy. The economy is doing well. The level of problem credit unions is currently low. It is also important to note that risk-based capital standards are but one element in a comprehensive set of safety and soundness standards and requirements implemented through the examination and supervision program. Thus, the incremental risk posed by a 2-year extension of the effective date is manageable to ensure we implement the rule in a well-integrated way. This approach would be more efficient and less disruptive to both credit unions and the Ncua. I'll now turn the presentation back to Larry to discuss next steps.
Thank you, Julie. So if the board approves the proposed rule, it'll be published in the Federal Register with a 30-day comment period. This will allow the agency to analyze the comments and to develop a final rule for the board to act on by the fourth quarter of this year. Just to be clear, at this time, the agency would be seeking comments on the proposed new effective date. We will, of course, seek stakeholder comments on any other changes to the capital standards if and when they are proposed. That concludes our remarks, and we'd be happy to answer any questions you have.
Great. Thank you, Larry, and thanks so much to you and your team for your informative presentation and hard work on the proposed rule. As you all know, when I became chairman just a few months ago, I identified several key regulatory and supervisory priorities. The vital role of our capital standards play in protecting the safety and soundness of credit unions and the share insurance fund is very high among them. Our core mission as an agency is to maintain a safe and sound credit union system and be good stewards of the National Credit Union Share Insurance Fund. Moreover, the Federal Credit Union Act requires the Ncua to maintain a system of prompt corrective action for federally insured credit unions that is based on an institution's level of capital, that is, its net worth. The Act also requires us to maintain a risk-based net worth requirement for those institutions we deem to be complex credit unions. These are serious responsibilities which we must faithfully uphold, and I would be derelict and feckless in my responsibilities if I did not do so. I want to emphasize we enjoy a healthy and vibrant credit union system today that rests upon strong capital, as well as liquidity and effective management at its core. And it's important to recognize we regulate and supervise a business where federally insured credit unions must take well-managed and measured risk to achieve their member service mission. With the extensive diversity evident in credit union memberships, lending approaches, and business strategies comes a broad range of individual risk profiles. Therefore, we must be mindful that the capital standards for credit unions need to account for the diversity and risk exposure we insure. Thus, for all these stated reasons, I strongly support maintaining capital standards that are effective, not excessive, and are well calibrated to the risk in the credit unions we insure. I'm pleased to note that the credit union system is vibrant and prospering, enjoying a very strong level of net worth at 11.3% on average. The economy is strong, and the level of problem institutions is low, and the share insurance fund has a very strong level of equity. Therefore, I believe this is a good time for the board to holistically evaluate the NCUA's capital standards to ensure they will serve us well in the future. Staff today has noted three particular areas where additional consideration of the standard is warranted. The first is rules governing complex credit unions' use of subordinated debt to qualify for risk-based capital purposes, and related improvements to the standards for such instruments that qualify as secondary capital for low-income designated credit unions. Providing credit unions with an avenue to safely use subordinated debt to help comply with capital requirements and protect the share insurance fund is sensible. It seems self-evident to me that we would ensure the authority is in place before the risk-based capital requirements go into effect. This would allow eligible credit unions to safely use this tool to manage their compliance with risk-based capital. As chairman, I intend to ensure that a subordinated debt proposal is taken up by this board by the end of this year. I will repeat, I intend to ensure that a subordinated debt proposal is taken up by this board by the end of this year. The second area is the need to update the NCUA's capital requirements to reflect the risk associated with a credit union sponsoring a securitization of their assets. Asset securitization can be a useful tool for credit unions and other depository institutions in managing their balance sheets. But it is a complex activity that comes with various forms of risk, including credit risk, depending upon how it's conducted. Since this authority was recently identified as available to credit unions, the NCUA's prudential requirements, including capital standards, need to be updated accordingly. The third and final area is exploring a community bank leverage ratio equivalent for credit unions. Just last year, Congress required the federal bank regulators to adopt this provision to allow qualifying banks to have a simpler way to comply with capital standards if they maintain strong capital levels. I'm intrigued by the community bank leverage ratio option as a potential way to simple but effective relief for credit unions. It is going to provide them with that simple relief if they maintain strong capital levels. We should assess this thoughtfully before proceeding. It has the real potential to be a win-win for credit unions and the share insurance fund. All these are very principled reasons for considering a delay. I, having worked in banking and financial services as a loan manager, risk manager, product development manager as well, I want to make the point that while effective capital requirements are very important, risk-based capital standards are not a panacea for safety and soundness. Risk-based capital is designed to address a distinct range of credit risk outcomes, but not prevent credit-related financial institution failures caused by very severe economic scenarios. Further, capital standards are intended to work in tandem with a multifaceted array of risk mitigation requirements. These include standards for liquidity, credit administration, governance, and risk management, just to name a few, all reinforced by a robust examination and supervision program that is further supported by various NCUA enforcement authorities. With all this in mind, and a healthy economy, high credit union net worth over 11%, very low levels of problem institutions, and a strong insurance fund, the NCUA board can and should take additional time to carefully evaluate and make improvements to the NCUA's capital standards without creating undue risk to the share insurance fund. That is why I'm supporting this delay. This delay will allow the agency to take a surgical approach to implementing this rule in an integrated and coordinated manner rather than incrementally, which would be less efficient and more disruptive for credit unions and the NCUA. A two-year delay is enough time to propose and finalize the changes being considered and conduct a well-integrated implementation. Again, thank you for your time on this. I now want to have a few questions with you. How do you envision proceeding during the two-year delay period if the board finalizes today's proposal?
Chairman, well, as you indicated, 2 years would give us enough time to consider these other improvements to the capital standards that we've enumerated, as well as any other ones that get identified during that period, and to do it in a thoughtful and well-sequenced way. So we would envision working in stages, subordinated debt authority being, the first priority, as you indicated, having that ready for the board to act on before the end of the year. Then, as we move on to the next phase, looking at the community bank leverage ratio equivalent as an option for credit unions, and whether we can do it legally, and then if we can, should we, and what exactly would it look like, and proposing and finalizing that, as well as any other improvements, including the asset securitization. So we would look at this as you indicated, holistically, but we would stage it in so that ultimately when we had everything lined up, they would all be ready to go into effect by the end of by the new effective date of risk-based capital.
Great, thank you. Could you please, though, walk me through in a little bit more detail how you determine the incremental risk to the share insurance fund of a 2-year delay is manageable?
Yeah, so there's different ways to think about the risk. We've identified based on our current estimation methodology, and I do need to provide a disclaimer where we work with call report data on this. We're working with year-end 2018 call report data, and while it provides much of the data we need to do a credible estimate, it's not precisely aligned to the new risk-based capital standards yet. And so there are some assumptions we have to make and some estimations we have to use. But based on those estimates, we have 5 credit unions that are identified, 5 complex credit unions that are identified as having a deficiency in their capital to comply with the new risk-based capital standard of 10% to be well capitalized. And those 5 credit unions are deficient by about $50 million in assets. So, or $50 million, excuse me. So if those 5 credit unions failed over the next 2 years, which would be the period of the extension, then you would expect an incremental cost to the share insurance fund of $50 million. There are various other ways to think about that, the risk to the fund. Another way to think about it is the average asset size of credit unions in that class that are covered by risk-based capital and that are bound by the risk-based capital requirement, meaning that is the higher standard for them. Those credit unions on average have assets of about 1.8 million. There's a range, of course. But the average size is about 1.8 million. Just when you're doing estimates, you tend to work in billion. I'm sorry, thank you, billion. And so the average loss given default when a credit union fails is about 20%. That's a pretty consistent long-term historical average. So 20% of 1.8 billion in assets is 360 million. So that would be the cost. So if said another way, if risk-based capital was effective in preventing them from failing or preventing them from failing at a cost to the fund, maybe it would save on average $360 million over that 2-year period. Just for context, failures are not easily predictable. If we could predict them, we would avoid them, of course. And probably wouldn't be working for the government either. But the probability in a given year of a crane of that asset size failing based on our long-term reserving model estimations is less than 1%.
Okay.
It does happen, but
well, we're not soothsayers and clairvoyants. If only we could be. Can you please explain why we need to revisit how asset securitization activities are incorporated into the regulatory capital standards?
Well, so I think it's important to give a little history here. As you had indicated in your remarks, and as Juliet indicated, we identified in 2017, our Office of General Counsel did, that securitization was an incidental authority. So prior to that, we had not come to that conclusion. And we're not aware of any credits engaging in that activity. In fact, I'm not aware of any yet doing it, although we know of a few that are looking carefully into it. So that authority didn't really exist prior to that. Once that legal opinion came about, we kicked off a team to really look into supervisory guidance for asset securitization. And as we did the research about how the banking agencies handle that activity, because banks obviously are involved in that space, we identified a pretty extensive set of supervisory guidance we needed to put in place, both for the institutions and our examiners, and exam procedures, and some necessary resources and expertise that will need to go with that. But we also identified that the underpinning for that guidance was some regulatory standards, including capital. And of course, as you know, guidance is not enforceable. You need to have a regulation that goes through notice and comment in the Congressional Review Act process. So we have developed a package of regulatory and supervisory standards that we'll need to have the board act on in due haste to address this area.
Got it. Thank you. You mentioned in your presentation the adoption of a standard equivalent to the community bank leverage ratio as a simpler way to comply with capital standards, but may result in higher levels of capital held Can you explain how this would happen? Because to me, it almost seems counterintuitive.
So I think the concept that Congress asked the banking agencies, or I guess directed them really to implement, was to give, especially community banks, the smaller institutions, a simpler way to comply that was equivalent or perhaps even slightly higher in rigor, recognizing that most community banks and the vast majority of creditors, of course, too, are very well capitalized. They're not just well capitalized; they're very well capitalized relative to the leverage ratio standard, and even relative to the risk-based capital standards. And so, the thought is, if we have a simpler way of calculating that, risk-based capital standards, you go all the different asset classes that you have to identify, and then you have to risk weight those. So the complications can be complicated, and the math involved. This is a simpler approach. It says, all right, if you hold a certain amount of tangible equity, which is, by the way, a higher standard than the leverage ratio for banks. The leverage ratio includes all Tier 1 capital instruments. Tangible equity is a subset of that, and it's the highest quality of capital. And so if your tangible equity, the numerator, divided by your total assets, a very simple measure, is greater than a certain threshold, then you have complied with the capital standards and you remain well capitalized. The banking agencies, the law required them to pick a threshold between 8 and 10%. They chose 9 for their proposal. We'll see what ends up being in the final rule, so we don't know that yet. And there are some other qualifying criteria. So they manage some outlier risks also through the qualifying criteria. You wouldn't even qualify to have this option if you have certain risk exposures. But assuming you don't and you're small enough, I think they said it was 10 billion if memory serves, then you can opt in as a bank to this simpler metric. And it reflects the fact that most banks and again, most credit unions maintain well in excess of the minimum regulatory requirement. And so if they've already have that capital for their own risk management purposes, they've determined they need that. This gives them a simpler way to do the calculation to show they're complying with the risk-based standards.
Great, thank you. Will the delay help credit unions with respect to FASB's new standard on current expected credit losses, or CECL, as we here inside the Beltway like to call it? And do the capital standards need to be updated to account for it?
So that's there's 2 parts to that answer. The first part is that our risk-based capital standard that would go into effect if it's not extended this January, or if it is extended January 2022, already includes all of the allowance account in the numerator of the calculation. So in that sense, CECL is not relevant, because whether it's in retained earnings or the allowance account, it's all counted as capital. So we don't need to modify risk-based capital for CECL. Credit unions, however, also have to comply with the net worth ratio requirement, 7%, to be well capitalized. And that does not include the allowance account. And so if CECL requires the allowance account to materially increase, it will reduce retained earnings, which is net worth, the numerator of the net worth ratio. And so this risk-based capital doesn't fix that. And so we are looking into other alternatives about ways we can mitigate that impact for credit unions, but that's still a work in progress, and we'd ask the industry to stay tuned on that one.
Great. I know that's an issue that I hear quite often about in my meetings with them. I really do want us to look at capital holistically. Are there any other areas of the capital rules that may need to be updated, since we are going to look at a holistic approach?
We don't have anything specifically enumerated other than maybe some small technical edits, but we will be, what we have found, and part of the reason why some of these other projects have taken a while, like subordinated debt and asset securitization, as we go in and think about that activity and then look at the capital standards and other parts of the regulation, we identify other changes that need to be made, not just because of that activity, but because of how they'll have to fit into the broader construct. And so I'm sure we'll identify specific things that we think warrant updating as we go through this process. And certainly as we go through the stakeholder comment process on those additional proposals, we'll get additional ideas, and we will thoughtfully consider them. And that may lead to some other possible changes.
And you know, I mentioned in my remarks, I intended to bring a subordinated debt rule forward by the end of this year. Can you tell me the estimated time frame from when a rule is proposed to when it can be final?
So, and I'm gonna paraphrase how our General Counsel Mike McKenna has explained it to me. once the board, like today, if the board approves this proposed rule, there's a comment period associated with the proposal, and so generally we strive for 60 to 90-day comment periods on more complex and technical matters. And so that comment period runs, we summarize the comments, we then analyze the comments, and then we work with the board to draft a final rule that we have to analyze the comments and we have to respond to them in the final rule. And we might also make changes based on those comments. And so we'd have to engineer those changes into the rule as well and then explain those. So that takes some time, as you can imagine. Then the board has to vote on the final rule. And then they'll set usually an effective date. It's not typically immediately, and we try to sequence it. Sometimes it's sequenced with the next call report cycle, or we span it out a while to give creditors time to comply. And that effective date is important for that reason, as well as the fact that we go through the Congressional Review Act process, where we analyze the rule to determine whether it's major, and we submit that information through OMB and GAO, and ultimately to Congress. And that process has to run its course too before we get to an actual effective date for that rule. So that could easily take a year. In fact, it's difficult often to do anything that's of any complexity in less than a year as a result.
So just to be clear, but this subordinated debt rule could be completed in conjunction with this delay.
Yes, with the extension of 2 years, it gives us time to go through that rulemaking process, which could take easily as long as a year, as well as any subsequent rulemaking like the community bank leverage ratio or others.
Or securitizations.
Or securitization and all of that. We wouldn't necessarily propose those all simultaneously. We'd stage them in. And so, but it gives us enough time to get all of that done, as well as work on implementation, the technical aspects of implementation, changes to the call report and systems and guidance for credit unions and all that sort of stuff. So you really do need more than a year if you're going to, of an extension here, if you're going to consider all of those things.
Great, and that really clarifies a good point, Larry, in the sense that if the delay is passed today, it doesn't mean that the agency is sitting idly and just waiting, but that there are other constructive things that are going to be done for the safety and soundness of our credit union system.
Yes.
I have no further questions. Thank you. Mr. McWaters.
Thank you, Mr. Chairman. You said, Larry, that the delay will not affect the safety and soundness of the share insurance fund. Can you help me better understand that? Why? I mean, if risk-based capital is needed, if it's important, why would the absence of that capital requirement not pose at least some sort of danger?
Well, I don't believe we characterize it as having no effect. I believe our characterization was that it was the manageable incremental risk and it wouldn't create undue risk. Okay. And in fact, in response to the chairman's questions about that subject, I threw out a few numbers about providing different ways to think about the potential incremental risk over the next 2 years in different ways of thinking about it in a range. So yes, risk-based capital does a better job with a certain class of credit unions that it applies to complex ones that in terms of having a higher minimum capital requirement than the current system in place. And so that incremental risk is what we're talking about as being manageable to the insurance fund. And it's a factor of the additional level of capital it would require, as well as the probability over the next 2 years that one of those institutions fails at a loss to the fund.
Okay. There was a Cbo analysis done some time ago on a bill proposed by Congress, and the Cbo concluded that, I think, if we don't have a risk-based net worth provision in place over the next 10 years, it could cost us $1 billion or so. Help me understand that and how that Cbo analysis actually relates to what we're actually proposing. They seem to me to be apples and oranges a little bit.
Yes, I think the number they had, and they had a couple of different numbers in that study, and I should first start out by saying I'm not an expert in how Cbo conducts their analyses, but having at least read the final report, my understanding is there's the incremental cost to the insurance fund of, I think it was about $1.2 billion over a 10-year period. So that was the cumulative amount over the entire 10-year period. And then there's the incremental cost to the taxpayer. It was based on it was in response, I believe, to legislation a year or two ago,
Right.
to repeal RBC, not just to delay it. And so it was working with data that was several years old, at least a few years old at this point, as well as using the CBO's approach to making the estimate. And so, having said that, if you accepted the premise that it was that 1.2 billion was reasonably accurate in the ballpark, that would accrue over the entire 10-year period. And then the next question is, well, what's the specific timing of those losses? Does it come in one big chunk? Does it kind of come evenly spread throughout? Does it come all at the end? And so, when you start to get into the specific timing, you get into more assumptions and estimates and guesses. But I think a simple way to think about that is if you just straight lined it, 1.2 billion divided by 10 years is 120 million a year. So if we were to assume an average loss, incremental loss of 120 million a year for 2 years, that's 240 million, which is about 2 basis points on the equity ratio, which currently stands at about 1.38.
Okay, so that number compared to the number where you responded to the chair a moment ago of around $50 million, right? Those are the credit unions that would have a higher capital requirement under risk-based net worth than under leverage ratio, right? Yeah. So CBO is looking at this as a bit of an outsider. You're the insider, you're the professional, you're head of E&I. This is what you worry about all the time. So your analysis that over the next couple years during this delay period, if those 5 credit unions were to have a problem, and the problem was caused by insufficient capital, which is a big if. Okay, there's a lot of other things going on here. But if they were, then the hit could be $50 million.
Yeah, so again, because we're not clairvoyant, I think that's a great word. I like to think in terms of different ways of looking at the risk and a range of outcomes. So one way of looking at it is these 5 cranes we've estimated are deficient by 50 million. If they fail because of credit risk, which is what risk-based capital is designed for.
Right.
Your point is completely valid. If they fail for some other reason, interest rate risk or something else, that's not what risk-based capital is designed for. We have other mechanisms, as you articulated, in a multifaceted approach to try to address that. But if it's credit risk driven, then you would certainly expect an incremental cost of about 50 million for those 5. I also gave the statistic of if you just assume we prevented the average size crane in that class that's bound by RBC, it could be as much as 350 million. And then if you did the straight line approach with CBO, it's maybe 240 million. So there's a variety of different ways to think about it, all of which you're talking about between half a basis point and 2.5 basis points to 3 basis points on the equity ratio of the fund, which is about 138, drops it to 135, all else being equal, 134, depending on where we're trending, and which is still more than we've ever typically managed to it in the old historical framework of 1.30.
Okay, so I think it's important also, as the chair noted, that capital is not a panacea. This is not a theoretical academic comment. If you go back to 2008, 2009, the financial crisis was a liquidity crisis. At that time, capital may have been eroded, but nobody cared. The only thing that mattered in 2008, 2009 was, will my checks clear? If my checks clear, I'm good. Checks weren't clearing, we needed TARP, which is $700 billion of liquidity of cash. So we also learned recently with certain taxi medallion credit unions who had capital of over 40%, approaching 50%, didn't work out well. That was not enough capital for those particular facts and circumstances. So I wish capital was the answer to everything, but it's not. You mentioned a moment ago in response to the chair that there were these 5 credit unions that would have higher capital requirements under risk-based net worth and under tangible net worth. Is that correct?
Could you say that again?
That there are 5 credit unions that would have a higher capital requirement under net worth, risk-based net worth, than under just tangible leverage ratio.
The net worth ratio, yes.
Okay, so it's 5.
Based on our estimate,
okay.
yes.
So when I hear that, does that mean that somehow this risk-based net worth we have on our books now is somehow not rigorous because there's only 5? I mean, how does this compare to like what the Fdic has with respect to their risk-based capital rules?
So there's a couple of dimensions to that question. The first one is a comparison between what's on the books currently, the risk-based net worth requirement, and the risk-based capital ratio that will go into effect at some point in the future. Currently, risk-based net worth requirement only picks up 1 credit union. The RBC, in terms of a downgrade in their capital category, RBC picks up 5. RBC is also much more effective at being a higher binding constraint for a larger number of complex credit unions. Under the current system, it's maybe 100. Under the proposed system, it's somewhere between 170 and 260. So it's doing a better job of raising the bar for the more complex and riskier credit unions. But all but 5 or 1 have it, right? It's just that they'd have to keep more than what they couldn't run their capital down below those new thresholds. The second comparison would be between risk-based capital requirement and the risk-based capital requirements slated to go into effect and the risk-based standards for the banks imposed by Fdic. I need to first preface this comparison with the fact that under the Act, under our law, we only apply the risk-based requirement to complex credit unions, which is a subset of the credit union community. And as we've defined it, it's over 500 million in assets. That's 545 credit unions. So it's downgrading the capital category on an estimated basis of 5 of those 545 credit unions that it's subject to. The risk-based capital standards for banks are applied to all banks because Fdic and the banking agencies don't have that statutory constraint about only applying it to complex. And for them, it's 20 institutions that the risk-based downgrades their capital category out of 5,500 or so. So there's some proportionality there. We carefully looked at when we design risk-based capital. It is a balance. It's a balancing act. It's not a panacea, and you can dial it up too high, and then it creates inefficiencies in the system because you make them hold too much capital. But it can also create a significant competitive disparity between federally insured institutions. If for a particular loan activity, for example, our standard is much higher than the banking agencies, that same loan that would be made to that same consumer at the bank will have a lower capital charge than it would at a credit union, and that creates competitive issues. So we have to think about that as another variable in this dialogue. And we look closely at that when we design the risk-based capital system, because we actually have a mandate in our Act to be comparable, which we translate as equivalent and regular, not identical, but equivalent and regular. And so when we did the risk-based capital design, risk weights and risk assets categories and weights, there's a few areas where credit unions had a demonstrably better performance, auto lending, for example, and we gave them a slightly lower risk weight, not a significantly lower, but a slightly lower risk weight, which also aligned with Basel European standards for that. And in a few other areas, we actually have a more conservative approach. We account for credit concentration risk in our risk-based system. The banks don't. The banking agencies don't. And so for certain concentrations of business lending or residential real estate lending, we actually have a higher capital charge. But on net, when you put it all together, it's overall equivalent.
Okay, so objectively, and looking at this fairly as the subject matter expert within this agency on this issue, it would be a mistake to conclude, in your opinion, that the NCUA's risk-based net worth rule is less rigorous than the banking agency's net.
I wouldn't come to that conclusion. Reasonable people could certainly have their own opinion and disagree on that matter, but I believe it's equivalent.
Okay. So during this period, during this 2-year delay, we will, I assume, look at this rule. There may be aspects of it that we determine maybe something can be loosened, but maybe some things need to be tightened. Is that your understanding too?
Yes. In fact, as we indicated, one of the 3 areas where we do need to use your term, tighten, to have actual standards for that are meaningful is in the asset securitization space. There could be others. We've committed to, you mentioned the taxi medallion credit unions. We've committed to implementing recommendations made by our Inspector General about, a different, more concentrated approach to deal with concentration risk. And that's going to manifest itself in a variety of ways. We're going to change how we approach examining institutions with high levels of credit concentration risk. So part of that challenge is identifying what specifically are we focused on, having metrics to drive that, identify those institutions and drive the supervisory process for that, and the standards we'll use. And it will also perhaps involve, over a slightly longer time horizon, looking at our regulatory standards, including capital, for those areas. So that's something that would be factored into this 2-year window as well.
Okay, so there's work to be done on the rule. And I should also note that when this rule was proposed and finalized, I dissented from it. And I dissented from the rule because, in my view, as a lawyer for over 37 years, the rule violates the Federal Credit Union Act. I said that twice in written dissents, in some detail, and some legal analysis. Now, I understand the reasonable minds may differ. Other people in this room have a different view. I respect those views. But I also think that if this delay passes, we should look at that. We should go through that analysis again. I don't want a rule on the books that, in my view, as a lawyer, dealing with issues like this for a long, long time simply does not comply with what Congress told us to do. So I hope that we can do that. Mr. Fazio, let me ask you a couple more questions. The credit union, or the community bank leverage ratio, came about in Senate 2155, and it seemed like it was a directive by Congress to the banking regulators to give some sort of regulatory relief to community banks. So help me understand how this rule works. I mean, in effect, what I think it does is that it would exempt or allow community banks to opt out of compliance with risk-based capital if they comply with this new higher standard for the community bank leverage ratio. In other words, if to be well capitalized as a bank is 7%, picking a number, 5%, let's say, is to be well capitalized, and then what's been proposed by the banking regulators is a 9% community bank leverage ratio. If the banks have 9% leverage ratio, they can just simply not comply with the risk-based capital rule. Is that?
So just with a few caveats, they have to qualify, first of all, for the option.
Under $10 billion.
And have a few other criteria.
Yes.
Right. Then they have to make the selection. They have to pick a path they want to go down.
Yep.
And then they have to meet that standard, right, of 9%. And so the way I think about it is that is the alternative to the other. I view it as an alternative to the risk-based capital system, not that they're exempt from it. That is their risk, one of two options to comply, and that's the option they pick. And as long as they then comply, they're considered well capitalized.
Well, I don't want to confuse the language here, but if they pick community bank leverage ratio and they comply with it, they don't have to go through the brain damage
Correct.
of risk-based
They
capital.
don't have to go down that path and make those calculations.
Because according to Congress, if you have this number, if you have a community bank leverage ratio of this number, then you're good for capital.
Correct.
Okay. So I also read, again, this is anecdotal. Who knows what's really going to happen? But then 90% of the community banks would elect into this. So if 90%, or let's say a substantial majority elected into it, then you would have a substantial majority of community banks not complying with risk-based capital rule.
Right. They're not.
Okay.
They're not doing those calculations.
So when I looked at the Federal Credit Union Act, I asked myself the question, does the Ncua have a statutory authority to implement its own credit union leverage ratio rule? In my analysis, again, I'm not beating this issue to death, but my analysis is sure, it does. So if we were to go down that road, and if we were to implement a similar rule, and if 90% of the credit unions were to opt into that rule, then a lot of the risk-based net worth rule that we've been debating now since I was like 14 years old, is going to be substantially mooted. And the irony, think about this. Suppose this risk-based net worth rule came into effect January 1, 2020, and a bunch of credit unions comply with it. But by January 1, 2021, we had a credit union leverage ratio in effect, and the 90% of them opted out. Then we would have all of those credit unions spending an entire year, all the regulatory costs, all the costs within this agency for something that's going to be mooted on January 1, 2021, which is one reason I support this delay. Let's go to supplemental capital, secondary capital, what we're calling within the agency subordinated debt, because this capital gives a misnomer that it's something to do with equity. It's not equity, it's debt. So how does that work for risk-based net worth purposes?
So it depends on what type of credit union you are.
Low income or not?
Right.
Low income.
So
Okay.
if you're let's do low income designated first. If you're a low income designated credit unions, you can issue subordinated debt, which counts as in the Act's terms as secondary capital. And they get to include it in the numerator for both the net worth ratio and if they're a complex credit union, also for the numerator of the risk-based capital ratio. If you're a complex credit union and therefore subject to the risk-based standard, and the board authorizes subordinated debt for other credit unions that aren't just low-income designated, which hasn't happened yet. So right now, only low-income designated credit unions can do this. But if we broaden that with the subordinated debt proposal, then complex credit unions could issue subordinated debt, and they could count it in the numerator for the risk-based capital ratio, but they cannot, unless they're low-income designated, they cannot count it in the net worth ratio numerator.
Okay. So here is an option that the chair has said we will bring before this board by the end of the year. And but that's just a proposed rule, right? Okay, we've had an ANPR. Spent a lot of time with that, spent a lot of time institutionally, a lot of resources spent on this. It's going to be a proposed rule, probably for a lengthy comment period because it's a complex rule, and then it will take time to analyze that. So it's going to take us probably all of 2020 to get this rule turned around into a final rule, would be my guess, or at least a substantial part of 2020. So again, we could be in that awkward situation of having risk-based net worth become effective, yet a year later have an option in place, subordinated debt, where credit unions could go to a market. The market will develop for this. The market doesn't exist now because it's not legally permitted, but can go to a market, borrow money, use that money for risk-based net worth purposes if they're not non-low income. Is that correct?
If they're not low income, yes.
Okay. So here we would be applying a rule that says you must have this kind of capital and then coming along later and saying, oh, by the way, here's another way to get it. It just seems like these should be, the chair's term is holistic, mine's integrated. Let's make it all this work together at the same time. I could go on, but I'm not. So thank you.
Thank you. Mr. Harper.
Thank you, Chairman. I approach today's proceedings about the need to further delay NCUA's long-debated risk-based capital rule with great skepticism. I appreciate the views of my colleagues on this matter, but we may have to agree to disagree. In my view, the agency's supervisory efforts should focus on the institutions and activities posing the greatest risk to the National Credit Union Share Insurance Fund, such as concentration risk. As such, I believe that all financial institutions backed by federal share or deposit insurance should hold capital commensurate with the risks held on their balance sheets. In the case of federally insured credit unions, such capital will protect taxpayers and credit union members by helping to either prevent credit union failures or mitigate losses to the share insurance fund when a credit union fails. Additionally, putting safeguards like the revised final risk-based capital rule in place before the next recession or financial crisis occurs is good public policy. After all, it's better to repair a roof before it rains than it is to patch it while it rains. With the recent inversion of the yield curve, we know that a recession is coming. We just don't know exactly when and how severe. Moreover, the recent losses at several federally insured credit unions that concentrated heavily in taxi medallion lending highlight the importance of why we need to swiftly implement, not further delay, this important safety and soundness regulation. These failed credit unions held significant concentrations of taxi medallion loans on their books, as much as 97% of all loans in at least one instance. According to the NCUA Inspector General's recent material loss review, the failures at Melrose Credit Union, Lomto Federal Credit Union, and Bay Ridge Federal Credit Union resulted in an estimated loss of $765.5 million. Let me say that again, $765.5 million to the Share Insurance Fund. This figure does not include additional losses that the fund would have borne if another credit union had not agreed to merge with Progressive Credit Union. Cumulatively, system-wide losses from excessive concentration in taxi medallion loans therefore easily could have exceeded $1 billion. I apologize to my colleagues in advance for the time that I will take today, but because any further delay in implementing the revised but long dormant final risk-based capital rule will produce consequences for the entire credit union system, I have many questions to ask. Larry, in the wake of the Great Recession, our sister agencies moved promptly to update and implement their risk-based capital standards. When did the FDIC implement its risk-based capital rule?
So they finalized it in 2013, and I think it had a couple-year delayed effective.
It was actually the following year. And when did the Federal Reserve implement its risk-based capital rule?
I think it was the same time period.
2014, correct. And when did the Office of the Comptroller of the Currency implement its risk-based capital rule?
Also, I think the same time period.
It was 2014, but community banks had an extra year to 2015.
That's what I was thinking, the 2 years.
Yeah. So what this proposed rule, which kicks the can down the road for 2 more years to 2022, suggests is that it will take federally insured credit unions 7 or 8 years longer to implement their risk-based capital rule than it will for banks and thrifts to implement theirs. Is that correct?
So if you're measuring between 2014 and 2022, it's 6 years. So 8 years.
Now, let's turn to the requirements of the Federal Credit Union Act related to capital standards. John, am I correct in noting that Section 2016 of the Act requires the NCUA Board to adopt by regulation a system of prompt corrective action to restore the net worth of federally insured credit unions that become inadequately capitalized?
Yes, sir, that's correct.
Second, does the Federal Credit Union Act require the adoption of a prompt corrective action system that is both consistent with Section 216 of the Federal Credit Union Act and comparable to the system of prompt corrective action prescribed by the Federal Deposit Insurance Act?
Yes, sir, that's correct.
And finally, which risk-based capital standard for federally insured credit unions is more comparable to the Federal Deposit Insurance Act? The current risk-based net worth standard adopted in 2000 and implemented less than a year later on January 1st, 2001, or the final risk-based capital rule approved by the NCUA board in 2015 and amended in 2018?
I would defer to Larry on that.
Larry,
So the RBC is more comparable.
thank you. Next, let's compare the coverage of the risk-based capital rules for banks and thrifts to the standards in place for federally insured credit unions. Larry, how many federally insured credit unions are exempt from the risk-based capital rule that is currently scheduled to take effect on January 1st, 2020?
Approximately 90% of credit unions are exempt.
So roughly a little under 5,000 if you have.
Yeah, so like 4,800, give or take.
Great. How many FDIC insured banks and thrifts are exempt from its risk-based capital rule?
I'm sorry?
How many FDIC insured banks and thrifts are exempt from its risk-based capital rule?
None.
Thank you. Regardless of how small they are?
Correct. They do not have the statutory requirement to apply the risk-based only to complex
Great.
institutions.
And what percentage of FDIC insured banks and thrifts is that?
100%.
Well, zero, none are.
I'm sorry. Yes, 100% are exempt.
Comply, but
Zero.
none are exempted.
None are exempt.
Great. And how many banks supervised by the Federal Reserve are exempt from its risk-based capital rule?
Same answer.
Zero. And what percentage of Fed-supervised banks is that?
0.
0%. How many banks and thrifts supervised by the Office of the Comptroller of the Currency are exempt from its risk-based capital rule?
0.
And what percentage of OCC supervised banks and thrifts is that?
0.
Now let's turn our attention to the international best practices contained in the Basel Capital Accords. Isn't capital the last line of defense that protects the share insurance fund from losses?
Before the institution fails, yes, it certainly helps mitigate the losses once the institution fails, although we obviously try to optimize our recoveries out of our asset management estate, and we use various mechanisms to try to do that also help protect the fund.
Doesn't capital also protect U.S. taxpayers from having to shore up the share insurance fund, as they did during the Great Recession, when the NCUA had to come to Congress to obtain and use a temporary multi-billion-dollar line of credit from the U.S. Treasury known as the Corporate Credit Union Stabilization Fund?
Could you re-ask that question?
Sure. Doesn't capital also protect U.S. taxpayers from having to shore up the share insurance fund, as they did during the Great Recession when Congress had to create the Corporate Credit Union Stabilization Fund?
So I think it's a function of a couple of things. It's the risk in credit unions, it's the capital they hold, and it's the equity we hold in the insurance fund.
But generally, capital protects, correct?
As a general, it's
Yes.
one of those protections.
Okay. And under the Basel Accords, which date back to the first Basel Accord in 1988, and they are now in their third iteration, risk-based capital is a key component in the regulation of all financial institutions. In other words, no modern system of financial institutions regulation operates without a meaningful risk-based capital component. Is that correct?
None that I'm aware of.
Okay.
It's one of the 3 key pillars in Basel.
Thank you. So no one relies on the leverage capital ratio alone.
Well, it's interesting. The history in Basel is that it started out only as a risk-based capital. The leverage ratio came into effect, I believe, with Basel III as a complement to the risk-based.
And we were the opposite. We, of course, began with leverage ratio and then migrated. Okay. Turning to NCUA's risk-based capital rules, how old is the current risk-based net worth rule that federally insured credit unions must follow?
Well, its origins date back to 2001.
Mm-hmm.
There's a couple of modifications along the way in terms of which cranes were subject to it and a few other technical changes in the risk weights. Like when we did the NGNs, we made it clear those had a 0 risk weight. But those were specific changes. But the original construct dates back to 2001.
And does that predate the Great Recession?
Of 2007, 8, and 9, yes.
Great. How effective was the current risk-based net worth rule in preventing losses and failures during the Great Recession?
Well, there's not an easy answer to that. It depends on which ones you're talking about. I think we should first point out that the standards we're talking about here today apply to natural person credit unions. The corporate greens have a different system that they're
I'm not talking about corporates today.
All right. So the corporate losses was a different. It's not really germane to this risk-based capital rule. So in terms of natural person credit union failures, we actually did reasonably well for as large of an impact on the economy that the Great Recession was. That had credit did by and large reasonably well, given the impact to the economy, as well as the exposure that credits had to mortgage lending. And so while the risk-based capital system that's scheduled to go into effect is better at relating risk to the capital to the risk. Excuse me. The RBNW requirement does do that to some extent. That's currently in place. So, I guess my point in saying all that is it's the increment between the two that would matter during the Great Recession. And I don't.
But Larry, did natural person credit unions fail during the Great Recession that had high concentration, say, of home equity loans on their books? Cal State 9 comes to mind.
Yeah, so the Cal State 9 actually, I think, memory serves, went down before the Great Recession.
It was right about, if I remember.
Yeah, but
correctly.
it was actually, that was more of a, in my recollection, it's more of a function of the concentration of the type of home equity lending they did. Very low real equity there, even before the house prices.
Let's move on. Of the more than 5,300 credit unions, how many are classified as undercapitalized or critically undercapitalized under the current risk-based net worth rule?
Sorry.
I believe 3.
As undercapitalized or critically undercapitalized under the present risk-based net worth rule?
Just a moment.
Let me think about it in a different way. With how many for the risk-based capital, if you will, portion of the risk-based net worth rule, how many are critically or significantly undercapitalized?
3 are significantly undercapitalized, 3 are critically
and that would be both for
undercapitalized.
leverage and for the risk.
So let me make a clarifying comment here. The way our statute, the Act, works for the risk-based, the most that the risk deficiency in the risk-based can cause your crane's capital category to fall is undercapitalized. It can't cause them to fall to significantly or critically.
That's the point I'm trying to make.
Yes. So it doesn't even, it would never cause a crane to fall that low. Only the leverage ratio does that. And that's designed right into the Act.
And how many are rated as adequately capitalized because the current risk-based net worth ratio is binding? I believe the answer is 1.
I believe, yes.
Great. And how effective was the current risk-based net worth rule in mitigating losses at the taxi medallion credit unions that recently failed?
So that the answer to that question is that the risk-based net worth requirement, while it would require those institutions to hold more capital than the leverage ratio, those institutions held levels of capital well in excess of that requirement, and even with those high levels of capital still failed.
As I mentioned earlier, the share insurance fund's losses from the taxi medallion lending were estimated to be at $765.5 million and could have been even higher. Those are funds that otherwise could have shorn up the share insurance fund or which could have been distributed to credit unions. Did the current risk-based net worth requirement result in any of those now failed credit unions having to hold additional capital even a year before they failed?
It did actually.
It did?
Yes. And I don't want to go into specifics, but a couple of those cranes did have a risk-based net worth requirement that was higher than their net worth ratio shortly before they failed. But again,
shortly.
Yeah, within a year or two.
Okay, but
Yeah.
what about 2 or 3 years before?
I don't have that committed to memory. I have to look and get back to you.
Would you?
Sure.
Thank you. With the $1 billion plus failure of the taxi medallion credit unions and the fact that only a single complex credit union fails the current risk-based net worth standard, can we conclude that the current risk-based net worth system for credit unions is broken?
I wouldn't say it's broken. I would say it's less. It's not as good as it could be.
As it could be. Okay. Thank you. Earlier, I noted that by law, the prompt corrective action system for credit unions needs to be comparable to the system established under the Federal Deposit Insurance Act and consistent with the cooperative nature of the credit union system. Can we conclude that our current risk-based net worth system is comparable to Section 38 of the Federal Deposit Insurance Act?
That would be a legal question.
Is the current system, John, comparable? The standard that is being enforced today, not the one that we're talking about delaying.
I would say it is, and only because it compares to the act, not the regulations itself. So I'd say you could argue that it is.
I think we're going to have to disagree, agree to disagree on that one. And would you say that since the Great Recession, the federal banking regulators have, Larry, increased or decreased the leverage and risk-based capital requirements for banks and thrifts?
So that's a nuanced. The answer to that's nuanced. For some institutions, like the too big to fail, the SIFIs, they implemented stress testing standards, which I think in effect increased both. I'm not aware of any changes to the leverage ratio since that time, and their risk-based capital standards were adjusted went into effect in 2014 and 15, as you indicated.
Okay, so generally increased. I mean, there are some variations depending on where you are, but
exactly.
Overall, you've seen an increase. Thank you. And since the Great Recession, has NCUA issued any corresponding changes to its risk-based capital risk-based capital rules for federally insured credit unions that have actually gone into effect?
That have gone into effect?
Yeah.
No.
Okay. If the banking regulators increased the capital requirements for banks and thrifts, and we have not maintained comparability as required under the law, isn't that effectively a decrease in the quality of the capital standards for the federally insured credit unions?
All right, could you ask that?
Sure. If the banking regulators have generally increased their capital requirements, and we have not maintained comparability as required by the law, isn't that effectively a decrease in the quality of capital standards for federally insured credit unions vis-a-vis the banks?
So if you accept the premise that it's not comparable, then they've raised theirs, and we haven't.
Okay. So comparatively, would you say that our current risk-based net worth requirements are stronger or weaker than the risk-based capital requirements for banks?
I'm sorry, I missed the first part of that.
So comparatively, would you say that our current risk-based net worth, so the current standard on the books, is stronger or weaker than those that are currently on the books for banks and thrifts?
Well, so that's an interesting question. There are actually elements of our current risk-based requirement, not the RBC.
I am separating risk-based net worth when I speak of being our current requirement,
okay, so
versus risk-based capital, which is the standard that we are considering to delay today.
And this question is about the current risk-based net worth?
Correct.
Okay, so the current risk-based net worth requirement does actually have some elements that are stronger even than the newer, the 2014, 13, 14, 15 bank book.
How so?
It does have elements of concentration risk for business lending and real estate lending in it as well. So again, it will depend on the type of institution you are, what choices you've made with your assets.
But overall,
I would say overall, if you had to say net, it's probably a little more generous than the current bank rule, but not necessarily categorically.
okay. Do the capital requirements for banks currently require them to hold an additional capital conservation buffer of 2.5% to avoid limits on capital distributions and bonuses to executive officers and similar employees?
There is a capital conservation buffer construct that applies to certain institutions.
Great. Is there a similar conservation buffer for federally insured credit unions?
No.
Okay. Doesn't Section 216 of the Federal Credit Union Act also require the NCUA board to design a risk-based requirement that takes into account any material risk against which the net worth ratio required for an insured credit union to be adequately capitalized may not provide adequate protection? Sure. I'm quoting from the Act, so the answer should be yes, John.
Great, then yes.
Great. Does NCUA's current risk-based net worth requirement meet the statutorily required test, Larry?
I would defer to the lawyer on that.
Well, I think he would probably defer to you because you're the one in the policy seat.
Yeah, but I don't generally want to make legal conclusions, and I think that's you're asking for a legal conclusion there.
Okay. Are there material risks that are not adequately protected by just our leverage capital ratio requirements, Larry?
Certainly.
What are some of those material risks?
Well, again, there's a variety of risks that credit unions are subject to, including banks and other financial institutions, material levels of interest rate risk, material levels of liquidity risk, risk of fraud, other forms of operational risk. And so there are things you can account for numerically, and there's things that you can't. And so I think the way we think about risk-based capital standards is comparability, credit concentration risk, and you deal with those other types of risks through other supervisory and regulatory mechanisms.
Thank you. Did NCUA's current risk-based net worth requirement provide adequate protection against losses at the taxi medallion credit unions? This is a judgment call.
So could you ask the question again?
Did the current rule, the one that's in place right now, provide adequate protection against losses at the taxi medallion credit unions?
That's a judgment call. I think that's a case of they held. So I mean, let's put a little context around that. It was a situation where the value of the collateral declined precipitously and in a material way. I think a 90% decline in value from the peak. The cash flows, the revenues that the borrowers could generate was materially affected by changes in the marketplace. And so when you had that confluence of events, even an institution with as much as almost 50% capital net worth couldn't survive that. So
you're essentially describing an asset bubble, correct?
An asset bubble combined with a disruption in a market, and so.
All right. Finally, Larry, as I recall, looking at the risk-based capital rule that should be going into effect in 2020, about 90% of the risk weights for credit unions are equivalent to or lower than the risk weights for banks. Is that correct? And I can see the pie chart in my head, but I can't see all the lines. But my recollection was at least 3/4 was identical. Another, slice of it was a little bit lower. It's mainly auto lending, and then another slice was higher, mainly credit concentration. But 97% of the risk weights were equivalent to or lower than. When you add that up,
I'd have to double check, but
okay.
I don't know that it's as high as 97. I'd have to double check.
I looked at the press release from when the agency passed the rule, so it's a yes.
Okay.
And 99% of complex credit union assets will have a risk weighting of 100% or less, and more than half will have a risk weighting of 50% or less. Is my memory correct there?
I don't have those statistics committed to memory, so we can get back to you on that.
Again, I looked it up yesterday, and that's what our material at the time the rule came out indicated. Let's talk about the adequacy of the share insurance fund. If capital is the last line of defense in protecting the share insurance fund and taxpayers from losses at federally insured credit unions, the normal operating level, which the NCUA board sets, effectively determines how much collective capital the share insurance fund has readily available to protect against losses. Is that correct?
Could you say the last
Sure.
last part of that?
Sure. That the board sets the normal operating level, and that effectively determines how much collective capital the share insurance fund has readily available to protect against losses.
If you mean in terms of loss absorbing capacity, yes.
Okay. So the normal operating level is very important to any discussion of capital requirements. The two interplay.
Yeah. So capital and other risk issues in credit unions inform.
If we had no capital standards for credit unions, let's just live in a world of make-believe for a moment, would we have to set the normal operating level much higher in order to protect against losses?
All else being equal, yes.
Okay, great.
If they were only investing in very safe assets, maybe not, but you know, like
One
treasuries.
could hope, Larry.
Yeah,
Right?
yes, exactly.
All right. What is the current normal operating level target for the share insurance fund?
1.38%.
Okay. And the comparable target for commercial banks and thrifts is the FDIC's designated reserve ratio. In 2010, the FDIC raised its designated reserve ratio effective in 2011. What level did they raise it to?
If memory serves, it's a 2%.
Bingo. When the FDIC raised its targeted designated reserve ratio to 2%, it said, quote, "It is also important that the fund not decline to a level that could risk undermining public confidence in federal deposit insurance. Furthermore, although the FDIC has significant authority to borrow from the Treasury to cover losses when the fund approaches zero, the FDIC views the Treasury line of credit as available to cover unforeseen losses, not as a source of financing projected losses." Going on, they wrote, "Setting the designated reserve ratio at 2% is an integral part of the FDIC's comprehensive long-range management plan for the Deposit Insurance Fund. A fund that is sufficiently large is a necessary precondition to maintaining a positive fund balance during a banking crisis and allowing for long-term steady assessment rates," unquote. The FDIC also noted that in its view, the 2% designated reserve ratio, it viewed it as, quote, "both a long-term goal and the minimum level needed to withstand a future crisis of the magnitude of past crises. Because analysis shows that the reserve ratio higher than 2% increases the chance that the fund will remain positive during such a crisis, the FDIC does not view the 2% designated reserve ratio as a cap on the size of the fund. It is worth noting, and I'm talking now outside of the quote, that the FDIC's action was not considered controversial. In fact, the agency only received 5 comments on the proposed rule. The Independent Community Bankers Association explicitly endorsed the proposed rule, taking the designated reserve ratio to 2% and suspending dividends until the ratio reaches 2.5%. The ICBA noted that the counter-cyclical approach of the rule, quote, "will benefit commercial banks during times of economic distress and should reduce the likelihood of any further special assessments." Finally, at a September 2010 roundtable organized by the FDIC, bank executives and trade industry representatives uniformly favored steady, predictable assessments and found high assessment rates during the crisis objectionable. Larry, am I correct in all that I have just said, in particular that the FDIC board has voted to suspend dividends indefinitely until the designated reserve ratio of the Deposit Insurance Fund reaches 2.5%?
So based on what you read and based on my recollection, that's the case.
Okay.
I mean, they did that back in 2010. I don't know what the current thinking is, and I'm not familiar with their contemporary decisions.
But we can agree to agree here.
My understanding is their policy is still as you described it.
Okay.
But
Is it also true that under the current policy, the FDIC would allow the Deposit Insurance Fund to grow until its reserve ratio hits 2.5%?
see, that's the one piece I hadn't heard about, so I'll have to take your word for that.
That ratio for banks and thrifts is nearly twice the ratio for federally insured credit unions that some trade associations have advocated for the Share Insurance Fund. They've actually advocated for a lower normal operating level than we currently have of 1.38.
Yes.
And so let's just say that they've argued for 1.3. That's about, if you double that, that's about 2.5, correct?
Yeah.
Okay,
Little less.
Is it true that the FDIC regularly assesses banks a deposit insurance premium?
So my understanding is their assessment system, they do have some assessment every year, premium, although certain institutions, I think, get a credit and then it sort of washes out, and it's because it's a risk-based system.
Well, and one also too needs to look before and after the crisis, and I appreciate that. And before the crisis, many really were not paying the premium, but after the crisis, they've all been paying at least some form of a premium.
Yeah, although
as the fund rebuilds.
Yeah, but again, I think they have some credit mechanisms for certain things, and so some of them may have like a premium, but then they get a refund.
Okay. The balance of the FDIC's deposit insurance fund grew to more than $100 billion in the third quarter of 2018. What approximately was the comparable balance on the share insurance fund?
Well, right now the fund is over 15 billion.
It was about 15.8. We've been floating in that. Great. Banks paid $8.2 billion in assessments in 2018, more than 8% of their fund. How much did federally insured credit unions pay in assessments for the share insurance fund in 2018? And what percentage of share insurance fund did those assessments represent?
Well, they didn't pay any assessments.
And so what percent?
0.
Okay. Other than truing up their 1% deposits in the share insurance fund, when was the last time NCUA assessed an across-the-board share insurance fund premium?
So if memory serves, 2000, well, are we talking about share insurance fund or stabilization fund?
I figured you were going to ask both. I'm happy to have a discussion of both.
All right. I want to say the stabilization fund was 2011.
10.
The last one was 2000.
And it was 12.42 basis points.
Okay. And then I think the share insurance fund would have been around that same time.
Stabilization 2013, we continued to it.
Oh, wait. Yeah, we had them back. I was talking stabilization fund. So stabilization fund went through 2013. Share insurance fund was 2010.
Yeah. Great. What percentage of the deposit insurance fund can banks count as an asset on their books?
None.
None. So banks don't count it. They have to write their premiums off as soon as they pay them, correct?
Yes.
In comparison, are credit unions allowed to consider any part of their assessments as an asset on the books?
Assessments, no.
How about their share insurance fund?
So when they make a contribution to true up the 1% deposit of insured shares, they count that as an asset.
But wouldn't they keep 1% of the fund on their books, and we technically only have 0.38 these days?
Yeah. Well, so the 1%'s the deposit, and then
so they keep some on their books and don't have to charge it off. Larry, is the point I'm getting to.
Yes, okay. But we don't call those assessments.
Last year, the NCUA board voted to exempt an additional 1,026 credit unions from the not yet implemented risk-based capital requirement by raising the threshold to $500 million. At the time, Larry, you said that only 221 out of more than 5,000 credit unions would be bound by the risk-based capital ratio versus the 7% leverage ratio, and that collectively those that had to follow the risk-based capital ratio as the binding constraint needed to raise $635 million more than they would have under the leverage ratio. Is $635 million more or less than the amount of the projected losses from inadequately capitalized tax and medallion credit unions? 765.5. Okay, less. Is $635 million more or less than the amount the share insurance fund has distributed to credit unions in 2018 and 19?
Less.
Okay. How much did those 221 credit unions, and you can give me an approximate number here, receive in distributions from the share insurance fund in 2018 and 19?
Most of them.
I'm looking for an aggregate figure.
I'm sorry?
I'm looking for an aggregate figure.
Of how much in distributions
did they receive, those 221?
Oh, I don't have that committed.
Would you say it's roughly 250 million?
I'd have to look it up.
Okay. We did a little checking. It was 210 million in 2018 and 41 million in 2019. Could those 221 credit unions have used the share insurance fund equity distributions to build capital reserves to comply with the agency's revised final risk-based capital rule? They got money in.
Right.
Could they have set it aside to make sure that they had to go to net worth? Could they have made sure that they set that aside?
So my recollection on the amount of distributions was in aggregate about 1% of their total net worth. So if they had $100, if they had $99 in net worth, they would raise it to 100. I do want to clarify for the 221, which the latest estimate is
257, as many as 257,
right,
Larry. We know that there's a range there. I'm going to get to that in a second.
All right. That is the incremental amount of capital they need to hold on to, but all but 5 of them already have it and then some.
Yeah.
In fact, of the 257, their total net worth right now is, or as of the end of the year, the data we ran, $48 billion.
48 billion?
Yeah, I think it was.
Okay.
Yeah, 48 billion, and their net worth requirement's 32 billion, the 7%, and the incremental amount RBC would require for those guys is about 800 million.
Yeah, the incremental, and the total deficiency of the 5 that are totally deficient is
only
about 48 million.
Yeah, yeah.
Okay. You anticipated where I was going. The importance of having the risk-based capital rule take effect in January 2020 is that the 257, or as many as 257 complex credit unions for whom the risk-based capital requirement is the binding constraint, is that they will actually have to hold additional capital if they expand activities on their balance sheets that have higher risk weights. Thus, as they add risk, they will be required to hold additional capital so as not to burden the less risky credit unions and their members, the share insurance fund, and possibly even U.S. taxpayers with the cost of protecting against their additional risk. Am I correct in noting that the current risk-based net worth system wouldn't require that?
It doesn't. It has one credit where it's requiring.
But right. But I mean, we're talking one, and I think Julie or Larry, you said earlier, it was approximately 100 or so that were captured by the binding risk-based net worth constraint.
Right.
And now we're talking 257.
Right. So it's more, but it's not the full amount.
Okay, wonderful. An important part of the capital regulation is how to protect the system against outliers. Let's dive into that issue. Roughly how many federally insured credit unions are there in the United States?
50, less than 5,400. 53.
5335 last call report. We've had some mergers since. If a credit union was in the bottom 1% of those credit unions, would you say, in terms of a performance metric, would you say that it's an outlier?
So it's an outlier from a scoping standpoint. It doesn't mean it's an actual problem because it depends on what metric you're talking about.
Fair enough. Yeah. If the credit union was in the bottom 0.5 of 1% of those credit unions, would you say that it's an outlier?
From a scoping standpoint, yes.
Okay. Before the NCUA board raised the risk-based capital threshold to $500 million last October, you said there were only 20 credit unions whose prompt corrective action categories would have dropped because of the risk-based capital rule. That is less than 0.5 of 1% of all credit unions. Wouldn't that make them outliers?
Yeah, which is why their ratios reflect that.
Yeah, okay. You also told the board that if the threshold were raised to $500 million, as it was, only 6 credit unions would have their prompt corrective action categories reduced by the risk-based capital rule. By my math, that puts them in the bottom 1/10 of 1% of all credit unions. Doesn't that make them extreme outliers?
They're definitely on the tail in terms of the risk base.
As I understand it now, you estimate that 4 credit unions would have their prompt corrective action categories changed. 1 is already, under the current risk-based net worth rule, is already adequately capitalized and it would remain adequately capitalized. And then 4 would have their
would lower
if the risk-based capital rule would be implemented. These credit unions constitute less than 1/10 of 1% of all federally insured credit unions. Doesn't that make them extreme outliers?
They're definitely outliers.
Okay. Is it fair for the remaining 99.9% of all credit unions to one day potentially pay through the share insurance fund for the bad decision making by the bottom 1/10 of 1% of all credit unions?
Well, so fairness is a judgment.
It's a subjective term.
It's a subjective term.
I had my theory class in graduate school. There are many different ways to say fair, but Larry.
So let me, if you don't mind, I'll try to answer your question. So at first we have to think about, are those institutions actually going to fail, or are they under stress, and are they going to rebound? And of course, we're closely supervising all of those institutions. So that's one issue. The second issue is there's a couple of reasons why. If you just think it simplistically of the ratio is lower, right? They're in the outlier category because they have a low ratio relative to everybody else. There's two functions to that, the numerator and the denominator. So maybe they had some losses that the risk profile might not have changed, the denominator. They might have had some losses which might not have been credit risk. It might have been some other type of risk that caused them to drop. Other ones, yes, they might have taken more risk, right, than average, or they might have had something adverse happen to them. Let's say they took, elevated risk, but not extreme risk, but in their particular niche that they serve, something happened. So it's not a broad economic thing, it's an idiosyncratic thing, and now they've got elevated delinquency. Delinquent loans are risk-weighted higher, drives up the risk-weighted asset denominator, which drives the ratio down. So my point is, it doesn't necessarily mean that they behaved inappropriately. It might mean that they did, but it's not automatically the case. It doesn't also automatically mean that they're going to fail. Some of them are definitely on the road to recovery, and so I don't want to jump to a broad conclusion. I think this plays out on a case by case basis, and we have to look at those institutions. The second question we have to ask ourselves is, so if they're behaving,
can we just for a second, Larry? Let me ask the question this way.
Okay.
If your credit union was in the 99.9%, would you be happy that you'd have to pay a share insurance fund assessment or not get a share fund distribution if Julie's credit union were to fail and she were in the was one of the 4 credit unions that was in the extreme outlier tail?
Well,
would you be happy? Yes or no?
I think the answer is, I generally, if I think about insurance in general, I'm not happy to have to pay premiums for insurance. And I don't like it when premiums go up because other people get in car accidents and my car insurance goes up, but I'm a safe driver. But also some accidents are just that, they're accidents. It wasn't anything inherently unsafe about what somebody was doing.
But we've already established that Julie's credit union was an extreme outlier and it was taking much heavier risks than other credit unions were as a whole.
And that's where I'm saying is that sometimes they're taking more risks, sometimes something bad happened, and it wasn't necessarily an ill-conceived or ill-managed venture. So we have to differentiate between the two.
Let's move on. When the board raised the risk-based capital threshold to $500 million last year, didn't one commenter note that nearly all 10 of the costliest failures to the share insurance fund came from credit unions with less than $500 million in assets?
How many out of 10 did you say?
Noted that nearly all of the 10 costly failures came from credit unions with less than, I didn't give a specific number, less than $500 million in assets.
I think back then, yes, most of our failures do come from small credit.
Didn't this same commenter note that raising the risk-based capital threshold to $500 million would exclude 17 credit unions with Camel Codes 4 and 5 ratings and 105 credit unions with Camel Code 3 ratings from the risk-based capital rule?
Are you citing a commenter?
Yeah.
Yeah, I don't recall that specifically.
But I want to turn now to the delay in implementation. The board first proposed raising the risk-based capital threshold and extending the implementation period by an additional year in 2020. You said, we believe that a 1-year delay is a good balance between providing additional time to adjust the proposed changes without unduly extending the effective date of risk-based capital. With this delay, credit unions subject to risk-based capital will have a total of more than 4 years to have prepared. Additionally, last October, when the board raised the risk-based capital threshold to $500 million and extended the implementation period by an additional year to 2020, staff with the Office of Examination Insurance told the NCUA board, quote, "We continue to believe a 1-year delay is sufficient. A 1-year delay is sufficient. Providing credit unions with an additional year before implementing the 2015 rule, making the total implementation period 4 years, is more than sufficient to allow credit unions to incorporate changes in the definition of complexity made under the final rule. So I'm asking myself, what has changed? Why isn't 4 years enough, especially when most banks implemented their rules more than 5 years ago, and our risk-based capital rule only technically impacts 257 complex credit unions for whom the risk-based capital calculation would become binding, and only really affects the 4 whose prompt corrective action categories would drop.
So a couple of points there. All 545 credit unions that are more than 500 million assets still have to gear up to comply. Now, the good news is
they've got the capital, Larry.
They've got it. But
I mean, we're ready, set, ready to go. Why are we hitting pause?
They have it, but they have to have the compliance management systems in place to monitor it and to make sure they continue to comply. And as they go forward, they'll have to think about the choices they're making in risk activities. So they're going to have to adjust their operations. Right. Let me finish the second thought there. So in the quote you gave there about the sufficiency was in the context of the change we made last time to complexity. Now with the board contemplating other changes.
Was the board not contemplating dealing with subordinated? Hadn't the ANPR gone out before then? Subordinated debt?
Yes, the ANPR had come out, but we hadn't committed to necessarily actually doing it. That's an advanced notice. That's an exploratory.
But we were working diligently internally with the idea that we would be moving down the road on it.
Sure.
Okay. Larry, last year, board member Metzger, whose chair I get to occupy, whose office I get to occupy, said at the time we were considering the extension. Credit unions will have approximately 6 years now, that is from the time we finalized the rule until 2020, between the inception and implementation of this rule to either raise capital or reduce risk on their balance sheets if necessary. And all available data suggests that the net worth of complex credit unions has grown by more than 25%, and they have reduced the risk of their balance sheets. As a result, the average complex credit union today has an 18% risk-based capital ratio. That's 800 basis points, 800 basis points, more than is required to be well capitalized, and more than twice what is needed to be adequately capitalized. We can now turn to implementing the final rule while moving on to other issues. Larry, was former board member Metzger wrong in his assessment of the capital strength of complex credit unions?
No.
Okay. Nearly a year ago, when the Ncua board considered the proposed rule to extend the effective date for the risk-based capital rule by 1 year, and that is a mouthful to say, board member Metzger also had the following colloquy with you. Board member Metzger, I do have a couple of questions, Larry. Again, this is a proposal. We have an existing rule set to take effect in January 2019, and I know we have systems to get up and running to capture the new data and talk to credit unions. So we have proposed a 1-year delay. Could we possibly do this in 6 months? To which you answered, it's possible. To which board member Metzger replied, okay, because I think that's one thing we have to think about too. We have these hard numbers, but if there's a way we can do that earlier, that's something we might want to consider. Board member Metzger followed up with a question to council asking if the board could bifurcate the effective dates. He asked, could we go ahead and maintain implementing this rule on January 1st, 2019, 5 months from now, but make certain elements such as the definition of complex or when we hold credit unions to the new standard effective at such time as our systems are up and running to capture that? Is that a possibility here? To which the Office of General Counsel replied, yes, it is. What I don't understand is why, if you stated less than a year ago that it was possible that we could implement the risk-based capital rule in 6 months, we now need 3 years, the extra year we gave them, plus the 2 we're considering adding on to them now, for this proposed rule to get it implemented. What has changed? Are complex federally insured credit unions in such terrible shape that they need 2 more years to prepare? Because the data that you've provided my office says that there are 545 complex credit unions that would be subject to that would be in the universe and that it would really only be binding on up to as many as 257. Most of those are better than adequately capitalized. They are, in fact, well capitalized under either standard, whichever is one. And there are only 5 that are merely adequately capitalized, and none are significantly undercapitalized. Collectively, the 540 well-capitalized complex credit unions constitute 99.25% of all the assets of complex credit unions. If the vast majority are already ready, do they really need 2 more years to prepare? So Larry, let me ask you this. Has the net worth of the system increased or decreased since the 2015 risk-based capital rule was adopted?
It's increased.
It's increased. In fact, that it's grown from 10.92% for the aggregate net worth ratio to an 11.14. Overall, it's added about from 131 to 167 billion. So that's what, 36 billion off the top of my head, math-wise. Yeah, okay. Additionally, has the aggregate risk-based capital ratio for complex credit unions, I'm not talking just the industry, I'm talking complex now, improved over the last year?
Yeah.
Yeah. By how much, Larry?
I don't know, was it 2 basis points?
I think, not 2, well,
20, I'm sorry, 20 basis points.
20 basis points. There
Yes.
we go. There we go.
20 basis.
One more point. Are we really saying that we could afford to distribute nearly $1 billion from the insurance fund over the last 2 years, but we can't ask the extreme outliers, credit unions, which are in the bottom half of the bottom 1% of credit unions, to hold more capital so that other credit unions and their members, or ultimately you as taxpayers, don't have to pay for the bad management? Are we no longer prepared to implement a rule that we originally proposed to implement?
Well, in terms of being prepared, the 6-month answer we gave last time was in the context of the operational, system changes and lead times we'd need to change call report and so forth. As to how to approach implementing the rule, that's a policy call for the board. Do they want to take additional time to engineer in these other issues that we've talked about and roll it out in an integrated way, or do we want to do it launch in January and bring online those additional changes subsequently? That's a policy call. There's no binding constraint there in terms of our readiness to do it.
Okay, let's look at the text of the proposed rule. On the first page, and again on the 4th page, it suggested that this regulatory change is necessary to, quote, allow the NCUA board additional time to holistically and comprehensively evaluate capital standards for federally insured credit unions. Didn't the agency begin working on the rule we are now proposing to further delay in about 2011?
You mean the RBC?
Yeah.
We started our exploration.
Yeah,
of that.
the back office work. I mean, we didn't get anywhere near to proposing a rule, but it was about 2011 that we began digging. Do we really need, that was 2011, we're talking about proposing to delay to 2022. Do we really need a full decade to holistically and comprehensively evaluate capital standards?
Actually, I think it was 2012.
Regardless, 2012 to
Yeah.
2022 actually makes it perfectly a full decade. Do we need a full decade?
Again, that's a policy choice. I would say that we didn't actually propose anything till 2014, so it took us time to develop a proposal, and it took till 2015 to finalize it. So you really couldn't have gone any faster than that. And then how long we take to put it into effect and to do some additional changes to it is a policy call for the board to make.
How many of the more than 5,300 federally insured credit unions do you expect will ever utilize the new securitization or subordinated debt powers that we're going to be working on?
I don't know for sure.
Give me the largest possible number you think.
Oh, I wouldn't want to speculate on the upper end of how many would use it.
You think a lot?
Probably not a lot.
You think it would be most?
If I were speculating, no.
You think it would be just some?
Some.
Okay, great.
And I do think it will be some.
Yeah, I'm not disagreeing with you there, Larry. Is even a single one of those credit unions a credit union that will be undercapitalized if we allow the existing rule to take effect on January 1st, 2020? as
Well,
currently planned?
None of them are doing it now.
Okay. On page 6 of the proposed rule, it reads that we need to delay this rule until the banking regulators develop the community banking leverage ratio as required by S2155. Did that section of S2155 apply to NCUA and credit unions?
No.
Okay. Is it safe to assume that if Congress had wanted us to comply with that section, they would have included us?
I don't like to make assumptions about what Congress.
All right. Is it possible that NCUA's rule was included because small, non-complex credit unions were already exempt from our risk-based capital? We would have been at 100 million at that point in time, which we raised up to it. Is that a possibility?
It's certainly possible.
Okay. When the Economic Growth, Regulatory Relief, and Consumer Protection Act became law, did Congress suspend or delay the effective date of the risk-based capital requirements for banks?
Not that I'm aware of.
Okay. Did the banking regulatory agencies suspend or delay their risk-based capital rules while they adopted the changes required by S2155?
Well, so their rules are in effect.
They're in effect. So did they go back and suspend them and said, "Oops, we're gonna go away right now on these rules, and then we're gonna come in with the leverage ratio, the community bank leverage ratio"?
So they didn't say, "Oh, we're going to ignore the risk-based standards until this goes into effect." Just like we're not. We do have a risk-based net worth requirement on the books, so it's not like we're suspending all risk-based standards.
Okay. But if banks didn't get their more stringent risk-based capital requirements suspended or delayed, I have to ask myself, why should credit unions? If the NCUA board decides that even despite the exemption for all credit unions under $500 million, which spares 90% of all credit unions from the risk-based capital rule, that an alternative leverage ratio is needed, doesn't the board have the authority to adopt such an alternative at that time, separate and apart from the risk-based capital rule that's going to go into effect? In other words, Larry, the rule goes into effect. Does the board, and maybe this is a better question for John, can we then come at a later date and time and say, hey, we need to have an equivalent to the community bank leverage ratio and put it in place?
Yes, you need to propose it. That's the standard process.
Yeah, absolutely. Larry, I'm sorry that I'm almost out of my first bottle, so you know I'm nearing an end too. Thank you, John. On page 7 of the proposed rule, it states that extending the implementation period, quote, would be reasonable and would not pose undue risk to the share insurance fund. What's your definition of undue risk?
Well, ultimately, the board has to make that decision, of course, but as the
subject matter expert who advises the board.
I think of it in terms of ability to achieve our overall objectives and maintain a healthy fund. And so I would start to get worried if it's more, would represent more than a couple basis points on the equity ratio. I would have a lower tolerance in a situation where the equity ratio was low. So it's kind of a scale. If we were close to our statutory floor of 1.2 million, we'd have a much lower tolerance.
1.2% for the normal. You said million.
Sorry, 1.2%. Yes. You'd have a much lower tolerance for right now. We're sitting at a very strong level at 1.38%. So I think we have a little bit more tolerance.
Okay. We talked earlier about the losses at the taxi medallion credit unions costing more than $750 million. And if you had thrown in the potential progressive, that could have been more than $1 billion. Does that qualify as an undue risk?
Certainly.
And certainly then it would qualify as a material risk as well.
Certainly.
Okay. Is preventing and mitigating the next crisis, which is likely to be different from the past crises we've encountered, a risk that we can afford to ignore? Is that reasonable?
No.
Okay. A 2004 report from the Government Accountability Office said that the current risk-based capital net worth rule does not define as complex any of the 5 largest credit unions and defines as complex only one of the 10 largest credit unions. So this 2000 report said that our risk-based net worth rule was not capturing essentially the top 10. It was only capturing one in the top 10. How many of the 10 largest credit unions fit the definition of complex under the agency's current risk-based net worth rule? And how many would fit the definition if we allowed the 2015 rule to go into effect in 2020 as planned?
So the answer to that's a little complicated. I'll walk. For the sake of the audience, I'll walk through how the current RB&W construct works. So it's what's currently in place. If the credit union is less than 50 million in assets, it's categorically exempt. If the credit union is more than 50 million in assets, they have to do the calculation to determine what the risk-based net worth ratio is. And if that result is less than 6%, they are exempt. So they'd be both greater than 50 million, but less than 6% risk-based net worth requirement ratio. Everybody above that is defined as complex. So it's sort of it's a bit circular in that sense. Mm-hmm. So then the next question is, once you're complex, you are subject to the risk-based net worth requirement. And then the question becomes, is that level of capital required greater than the net worth ratio? And if your risk-based net worth ratio is lower than your actual net worth, you're still well capitalized. If it's less, you'd be less than well capitalized. And so it's a multifaceted definition of complex that's wrapped around those calculations. And so I don't have the numbers committed to memory of how many of the credit unions that are the largest that you referred to. They certainly meet the first test. They're greater than 50 million. I do believe there's some that have a greater than 6% net worth, risk-based net worth ratio, although I'd have to double check that. And then the final question is that number higher than their actual net worth? And I don't believe that's the case for any. Well, I know that's not the case for any of them because there's only the one.
Only the one. Okay, great. Another GAO report in 2012 entitled "Earlier Actions Are Needed to Better Address Troubled Credit Unions" found that the credit unions that became undercapitalized and entered prompt corrective action between 2005 and 2011, which includes the Great Recession, only 2.9% entered this status because of NCUA's risk-based net worth requirement. The other 97.1% entered prompt corrective action status because of their leverage ratio was too low. Do these results suggest that the current risk-based net worth, again, the one that's on the books right now, and the one that will continue to be on the books until 2022, if we were to adopt this proposed rule, do the results suggest that the current risk-based net worth worked well during the Great Recession and that we can afford to wait another 2 years to implement a revised system, especially when we already know that a recession is coming, given the inversion of the yield curve?
So
there's a lot compacted into that.
Yes. Can you read it again? I'm sorry.
Essentially, the GAO results said only 3% did it because of the risk-based net worth requirement. 97% did it because of leverage ratio that they failed.
Which GAO report was that?
This was the 2012 GAO report.
Okay.
And I'm asking you, do these results suggest that our current risk-based net worth capital worked well during the Great Recession? I don't think it did. You may agree to differ. And then I go on to raise the point that we know that the next recession is coming. Why shouldn't we implement the current?
Well, so we wouldn't have proposed risk-based capital if we didn't think it was better than the current risk-based net worth requirement. I think that goes without saying. So could the risk-based, had we done that prior to the Great Recession, hindsight being 2020, it would have been better, but it wouldn't have been a panacea for that the rise in the problem institutions and the failures. In terms of the timing of a recession, I mean, I don't know that. At some point, I think it's fair to say that there's a greater than zero probability that at some point in the future there will be another recession. But exactly when and how severe it is, I don't know, and I don't want to speculate. Can I go back to I'd like to mention one other thing about the largest credit unions I should have mentioned in my answer to the prior question. We have implemented post-crisis a stress testing and capital planning regime for our largest institutions.
Very good point, Larry.
That actually is very prudential and really is their binding constraint. It's going to drive their capital behavior much more than the risk-based one.
All right. I do have more questions, but I'm going to move to my closing remarks, Mr. Chairman, in the interest of time. In closing, it's often said that those who forget the past are condemned to repeat it. In terms of this latest risk-based capital effort, we are forgetting the past repeatedly, just like the characters in Groundhog Day. After a decade of work on a new risk-based capital regime, the Great Recession, and the recent taxi medallion credit union failures, it is time for us to move ahead. To protect taxpayers, federally insured credit unions, and their members, we should no longer wait. A further delay is bad policy in my view, because the existing risk-based net worth requirement is ineffective. It is binding on a single credit union, and while the proposed rule is currently projected to be binding on as many as 257 credit unions with $456 billion in assets, that's about a third of the credit union system overall. I think we should move ahead. As those credit unions expanded their relatively risky activities, they will be required to hold additional capital commensurate with that risk. Thus, we will be protecting the share insurance fund before there is a problem, rather than assessing premiums after the fact, as we did in the Great Recession. Furthermore, the additional capital will come from the small number of credit unions with relatively risky balance sheets, not from the vast majority of credit unions with less risky balance sheets. I am not prepared to support something that the credit union system does not need, which isn't in the public interest, and which the recent losses at the taxi medallion credit unions proves is not in the best interest of federally insured credit unions. The 2015 risk-based capital rule brings NCUA finally into greater compliance with the Basel framework and is consistent with the cooperative nature of the credit union system and provides comparability to the other federal banking regulators as mandated by the Credit Union Membership Access Act. I am willing to work with my fellow board members on separate rulemakings on topics like subordinated debt, finding an equivalent of the community bank leverage ratio, and the other matters that are discussed in this rule. But I want to move forward at this point in time. In my view, an additional 2-year delay of this important safety and soundness standard will make NCUA a day late in meeting the recommendations of the GAO and our Inspector General, and the Share Insurance Fund $1 short when another credit union is liquidated because it failed to hold capital commensurate with its risks. Accordingly, I will vote no on this proposed rule.
Thank you, Mr. Harper. And Mr. Fazio.
With your indulgence, Mr. Chairman, we talked a lot about risk to the fund, and we talked a lot about the equity ratio and the normal operating level. I would just like to give our audience, our stakeholders, some context. We, under then Chairman McWater's leadership, developed an approach to managing the strength of the fund. We have a very robust new process we've used for the last 2 years to set the normal operating level. We run the entire credit system through an econometric model where we shock their individual balance sheets relative to their actual capital net worth levels. And we base those scenarios on the Fed's severely adverse and severely adverse economic scenarios that come out each year. And that's what actually is a key driver of what we recommend the board set the normal operating level at. And so we have, and the board as a policy matter has chosen to manage to the adverse scenario, which is a fairly significant stress that you put the economy through. It's a moderate recession. It's not a severe, but it is a moderate recession. And the fund would not, based on that methodology, the fund would not fall below the 1.20% statutory minimum over a 5-year period, which is how the cycle of an economic recession typically plays out. And so I just wanted to give the board that context also in this dialogue.
I appreciate that, Larry.
Great, thank you. No further discussion. Is there a motion, please?
Yes, I move that the board approve proposed rule part 702 of NCUA's rules and regulations for a 30-day comment period as attached to the board action memorandum.
Is there a second to the motion? Hearing none, I second the motion. All in favor, say aye.
Aye.
Aye. All opposed, say nay.
No.
The motion passes 2-1. Before we adjourn today, I'd like to take a moment to mention that next month, or next week actually, the NCUA is celebrating the 85th anniversary of the Federal Credit Union Act. At the time of its enactment, the act was intended to make credit available and promote thrift through a national system of nonprofit cooperative credit unions. The Act has certainly lived up to its intended goals, and through our national credit union system, it has served and continues to serve the financial needs of many citizens that might not otherwise have access to safe and affordable financial services. I hope you will join us here at the agency next week as we celebrate the 85th anniversary, both here at the agency and at our regional offices. This is the end of our agenda today. There being no further business, we are hereby adjourned, and thank you all for staying with us.